Hello, welcome back. Hopefully you guys enjoyed the first part of Chapter 6, which covered activity-based costing. And now we're on to the next part of Chapter 6, Topic 6.5, which covers variable and absorption costing. All right, so what are these two different costing systems that we're going to be introduced to in Section 6.5? Well, let's start with absorption costing. Why am I starting with that? Because we've actually seen it before. We just didn't know it was called absorption costing. So absorption costing, also sometimes called full costing. Full costing. So let's take us back in time. So remember when we first started the semester, we learned about manufacturing costs, also called product costs. If you remember, those product costs were composed of three elements. You guys remember this? DM, DL, and Mo. So basically, absorption costing absorbs all these individual elements as part of the product cost. That's what we've been working according to this entire semester. Direct materials, direct labor, and overhead all make up the product cost. We're fine with that. So that's what we've been learning this entire semester. That differs from another costing system that's out there called variable costing, also sometimes called direct costing. Direct costing operates under the assumption that a product cost includes DM, DL, and Mo, wait for it, only the variable cost behavior components of your overhead, not the fixed overhead components, whereas absorption included both cost elements, your variable and your fixed. That takes us to cost behavior that we learned later in the semester that says we can take all of our costs and then classify them based on how they react to a change in the level of production. If they vary with a level of production, those are variable costs. We know DM, DL are variable costs, and that there are variable pieces of overhead. Indirect labor, for example, indirect materials, for example. There's also fixed overhead costs. Rent, for example, insurance, things like that. Absorption takes all these elements as part of the product cost. Variable only takes the variable costs as part of the product overall cost. That's the main difference between these two costing systems is how do they treat fixed overhead. Under absorption costing, fixed overhead, part of the product. Under variable costing, fixed overhead is not part of the product. So where does it go? The fixed portion gets moved to that other cost we talked about. We talked about product costs and period costs. So under the variable costing, fixed overhead costs are treated as a period cost if a company decides to use the variable costing approach. Why would a company use that? You'll read about in the chapter there's several advantages to using it. So why would a company use it? Why use? It follows CVP let's say rules, where we take all of our costs and we separate it by behavior, right? So it follows that, makes for easy analysis and calculations. Because remember all those calculations we learned? Break even, margin of safety, right? All those target profit. If we're using any of those formulas, we have to separate our variable costs from our fixed costs. So this makes easy to go ahead and proceed with those calculations. So these are some reasons why a company might choose variable costing when classifying their product and their period costs. The main reason is it allows for better control. If you remember when we started the semester, we said managerial accounting is all about helping managers plan and control and evaluate the operations. And we find that variable costing allows them to have that better control and better understanding of their costs. So that's why managers will take the time to reclassify their product costs into the variable system because of these advantages. So then why would anyone use the absorption method? It's required. Required by generally accepted accounting principles. Because of one important principle we learned last semester, it follows the matching principle. Remember that principle? Matching principle. Whereas the variable costing, one of its disadvantages is it violates the matching principle. And therefore, the variable costing method is not permitted for financial reporting, for fin reporting. So if a company is preparing its financial statements, they cannot use the variable costing approach when preparing those financial statements for the public. It's not permitted. They must use absorption costing. But most big companies see the advantage to it, and so they're willing to calculate their product costs both ways, absorption to meet the requirements, and also internally, the variable costing approach, because of the benefits of allowing them better control, understanding their expenses better, and being able to project certain key figures. All right, so now we know how the two systems differ and why a company would use one method over another. Let's talk about format. What's the format we can expect to see if a company is using absorption costing? Yoink. So if a company is using absorption costing, you're going to expect to see your 3-line header. This is going to be for the income statement presentation. Income statement. Company name, income statement for the year ended. We know all that stuff. Same thing for variable. And usually we'll try to identify in the header, this is an income statement prepared under the variable costing method. This income statement is under absorption. So we'll try to identify. That way the reader, internal in this case, knows that they're looking at a variable income statement and not an absorption or traditional income statement. Alrighty, what else do we expect to see? Well, if it's an absorption income statement, it's all the same format that we learned in 1A. Sales minus cost of goods sold. What comes next? I can't hear you guys, but I'm going to assume you said gross profit minus your operating expenses gives you net income. Can you guys see that? Oh, sorry. Golly goodness. All right. If a company is using the income statement by preparing it under the variable costing approach, the format's going to vary slightly. We talked about it following that cost behavior. So remember the format that we learned that shows an income statement by cost behavior? Equals net income, your contribution margin format. Sales minus variable costs equal contribution margin minus your fixed costs equals net income. Okay, now be careful, the two net income amounts will not always equal. We're going to do an example to see when the two amounts are equal and when they're not. But for now, I just wanted you to understand the difference between the two methods, the advantages, and the formats, the different formats that we'll see for the income statement, whether the company uses the absorption method to account for its product costs or the variable costing method to account for its product costs. Okay, so join me on the next video where we will go through the calculations for these two systems. Thanks.